Value investing. Value investing is an investment strategy focused on buying stocks that appear to be undervalued in comparison to their intrinsic or book value. In simpler terms, it's about finding high-quality companies whose stock prices are lower than they should be, often due to short-term market fluctuations or temporary challenges. The core idea is that the stock market sometimes overreacts to news, good or bad, leading to price swings that don't reflect a company's long-term potential. Value investors believe that these market overreactions provide opportunities to purchase stocks at a discounted price, even though the company's fundamentals haven't changed. To identify these undervalued stocks, value investors use a variety of financial metrics like price to earnings, PE ratio, price to book, PB ratio, and free cash flow. These indicators help determine whether a stock is priced lower than its true value. Value investing is often associated with legendary investors like Warren Buffett, who has used this strategy to build long-term wealth. The key is to focus on companies with solid fundamentals, strong management, and consistent earnings, and to be patient enough to hold on to them while the market catches up to their true value. This strategy requires discipline and a long-term outlook, as it can take time for the market to recognize the true value of the stock. But for those who stick with it, value investing can lead to substantial returns over time. Growth investing. Growth investing is a strategy where you focus on buying stocks of companies expected to grow at an above-average rate compared to others. Unlike value investing, which looks for undervalued companies, growth investing is about finding businesses that are expanding rapidly or have the potential to do so in the future. Growth stocks often come from sectors like technology, healthcare, or renewable energy, where innovation is key. These companies typically reinvest their profits into expanding operations or developing new products, rather than paying dividends. When evaluating growth stocks, investors look for signs like strong revenue and earnings growth, a competitive edge, and a large market opportunity. Because these companies are expected to grow quickly, their stock prices often have higher PE ratios, meaning investors are willing to pay a premium for future gains. Growth investing can offer significant returns, but it also comes with higher risk. Companies may not always meet their growth targets, and their stock prices can be volatile. For those who are willing to take on this risk, growth investing can provide great rewards over time. Dividend investing. Dividend investing is a strategy where investors focus on purchasing stocks from companies that regularly distribute a portion of their profits to shareholders in the form of dividends. This approach appeals to those looking for a steady income stream in addition to potential capital gains. The key to dividend investing is finding companies with a strong history of paying consistent and growing dividends. These are typically established, financially stable companies, such as those in the utility, telecommunications, or consumer goods sectors. These companies may not experience rapid growth, but they offer reliability and income, making them attractive to long-term investors. By holding dividend-paying stocks, investors can enjoy periodic cash payouts, which can either be reinvested to purchase more shares or taken as income. The primary metrics for evaluating dividend stocks are the dividend yield, how much income is generated relative to the stock price, payout ratio, the percentage of earnings paid out as dividends, and the company's track record of increasing dividends over time. Dividend investing is popular among those seeking lower-risk investments with reliable returns. It's also favored by retirees or anyone looking to generate passive income, while still benefiting from potential stock price appreciation in the long run. Index investing. Index investing is a strategy where you invest in a broad market index, such as the S&P 500, rather than trying to pick individual stocks. By investing in index funds or exchange-traded funds, ETFs, that track a specific index, you're essentially investing in a collection of companies within that index, giving you instant diversification. The main benefit of index investing is that it reduces risk by spreading your investment across many different companies, sectors, or even regions. This diversification helps protect your portfolio from the volatility of individual stocks. Index funds also tend to have lower fees than actively managed funds, since there's no need for a fund manager to pick stocks. Index investing is a passive strategy, making it a great option for long-term investors who don't want to constantly monitor or trade stocks. It's ideal for those who want steady growth over time with minimal effort, and it has proven to perform well over the long run by closely following the overall market. Momentum investing. Momentum investing is a strategy where investors buy stocks that have been performing well recently and sell those that have been underperforming. The idea is that stocks with strong upward trends are likely to continue rising, while those in decline may keep falling. This strategy relies on technical analysis, such as price trends and moving averages, to identify stocks with momentum. Momentum investors aim to capture short-term gains by riding the wave of rising stocks, but it can be riskier as trends can reverse quickly. It's ideal for investors who are comfortable with higher risk and looking for faster, short-term profits rather than long-term growth. Buy and hold. Buy and hold is a long-term investment strategy where you purchase stocks or other assets and hold on to them for many years, regardless of market fluctuations. The idea is to invest in solid, quality companies that will grow over time, allowing the value of your investments to increase steadily. This strategy is based on the belief that over the long term, markets tend to rise, and short-term volatility doesn't affect the overall trend. Instead of reacting to market movements or trying to time the market, buy and hold investors stay patient and let their investments grow. Buy and hold is often used by investors who want to build wealth over time with minimal effort. It's a passive strategy that's less stressful because it doesn't require constant monitoring or frequent trading. It's ideal for those focused on long-term growth and not concerned with short-term market noise. Contrarian investing. Contrarian investing is a strategy where investors intentionally go against the prevailing market sentiment. Instead of following the crowd, contrarians buy when others are selling and sell when others are buying. The idea is to capitalize on market overreactions, such as when stock prices drop too low during a period of fear or rise too high during a market rally. Contrarian investors believe that the majority of investors often make emotional decisions, causing stock prices to move too far in one direction. By going against the herd, they aim to buy undervalued stocks when the market is overly pessimistic, or sell overvalued stocks when the market is overly optimistic. This strategy requires patience and a strong belief in your research, as it can take time for the market to realize the true value of a stock. While it can be riskier, contrarian investing offers the potential for significant gains when the market eventually corrects itself. Dollar cost averaging. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. For example, you might invest $500 every month into a particular stock or fund. This approach helps smooth out the effects of market volatility by buying more shares when prices are low and fewer shares when prices are high. The idea behind DCA is that by consistently investing over time, you reduce the impact of short-term market fluctuations and avoid trying to time the market. This strategy is especially useful for long-term investors who want to build wealth gradually and reduce the risk of making poor investment decisions based on market timing. Dollar cost averaging helps eliminate the stress of market timing and the fear of investing large sums during market highs. It's ideal for those who want to invest consistently without worrying about short-term price movements,